Magan here is the Chief Executive Officer of Treasury Consulting LLP, and today we would be covering a very dedicated topic which is on covered bonds. I'm not sure how many people exactly know about that or not, but if you would have followed the crisis that has happened in 2008, 2009, when the entire world financial system crashed and the US banking system has got a major hit. On the contrary, I'm not saying that the Europe was able to save himself, but Europe was acting as a floating economy only because of the covered bonds. In my personal opinion, covered bonds is one of the biggest innovation which we have in the bond market. I'm not sure why the countries like India do not have any market as far as the covered bonds is concerned. In fact, the securitization market is pretty fragile. It's in few thousands of crores. On the contrary, if you talk about in the US, then it is in trillions of dollars. The largest covered bond market is in Europe, and I have to say that all the successors of European Central Bank, I'm not sure again how many people are following the Bloomberg TV, but the ECB new successor is around the corner. All the successor of European Central Bank, they are a prime supporter of covered bond, and ideally they should be, because this is one of the best invention we ever had, to be precise. Before moving further, let me elaborate you that it's pretty easy to talk to us as far as the covered bonds is concerned. This is our fixed income platform. It's pretty easy. This is our fixed income platform. I hope you can see that. You just go to business domain and you just go to the bond desk. It will come right away, and you just need to go down, and I hope you can see that it's pretty responsive. You can see that. I hope this is cover bonds. So these three, this is a dedicated section for the cover bonds. The same platform is also talking it about this structured finance desk, which is this right up here, and it's also talking about the credit risk desk. It's right up here because all three are going to be involved in that. So special attention has been paid to each and everything, and it's getting live on 1st March 2018. Now here we go. What is the reason behind innovation of innovation of covered bonds? All those MBAs, those are watching this video, they're being taught that the only thing the corporate can raise is the bond. Of course, they are not wrong, because you're studying in India, and when there is no market, so you will not get in the books also. You're not wrong about that. When a corporate issue a bond, the value of the bond, in fact the coupon of the bond and the yield also, is completely dependent upon the credit rating of that company. The biggest misconception, I'm not saying flaw, the weakness which we have in financial system is that there is no support of triple S swaps, which we have, like spread sensitive swaps. The spread sensitive swaps, we do not have any support as far as the India is concerned. I seriously doubt that maybe the next few hundred of years RBI is going to be taking to let it mandate it, right? So a company can issue a bond based upon its credit strength, and this credit strength would continue to be flat by the time the bond is not getting matured. So if today I am a company, Treasury Consulting LLP, and I am issuing a bond for 10 years and my credit is AA plus, then I'm assuming I'm getting L plus 50 bips, assuming is the rate, then that 50 bips is here to stay. Of course, I hope you heard about that. There is a big contention is there in IFRS, which is own debt accounting. If I'm going to be moving towards default or my credit rating is downgraded, then I would have a benefit, which I'm not sure I would have passed in the P&L or not. On the contrary, if I would have moved to a better credit rating from AA plus to AAA, right, then I would have a loss. On the contrary, I was having a gain when the credit rating went down. To resolve this issue, United States came up with the product of securitization, and not to mention that municipal bonds, securitization companies, and insurance companies, reinsurers, mortgage players, you just name it, they are the leading players in securitization. But again, there is a problem. Actually, securitization is off the book. What? You have a pool, you have just created an OTD model. OTD stands for originate to distribute model, and then I'm not going in detail, but one of the biggest reason of 2008 financial crisis was actually OTD model. Now the problem is that here you have created a SPV which is off the book, and if anything would have went wrong, then this SPV is answerable to you. But if that SPV was answerable to me, then why did 2008 crash happen? 2008 crash happened because people had took a lot of derivative position on that SPV. So the intrinsic value of the SPV was $1, while the derivative position was $1 million, and in some cases it went to $10 million, and net is history and rest is history. So the corporate finance came up with a term, neither you nor mine. So we would create a structure whereby the corporate will not run away from its responsibility. Of course, the credit rating would continue to play a role. At the same time, he is not allowed to create a off-balance structure. He would be creating something which is on-balance structure. Before moving further, covered bonds are nothing but on-balance sheet securitization liabilities. And this is a wonderful invention in the world of corporate finance if my personal opinion is going to be taken into consideration. It is nothing but on balance sheet securitization liabilities, and this is how exactly it works. You have a corporate, you have a bank, you have a financial institution. In case you are listening this from an Indian perspective, then this is not possible because RBI will never allow that. This is the complete structure of Europe. So you have a corporate, you have a bank, you have a financial institution. They are actually looking for on book funding. On basically the funding in the books, basically the on book securitization. So what they do, they will create a pool. Assuming the value of the pool is 50 billion, say $500 billion, assuming, take a hypothetical example. And now there is an issue. Once you have created a pool, there are two things to it. Now let's take an example of a company, say Microsoft. This is Microsoft, who has created a pool of $500 billion. Microsoft credit rating is AA plus. For a minute, take a simple example. Now, can Microsoft run away from its liability assuming the value of the pool would reduce to zero? Had it been the case of securitization, they would have easily. But in this case, they can't. But again, in this, the covered bonds is between a company and the securitization. But in the mind of an investor, there is always an issue. The issue is that who guarantees it? Yes, I'm dealing with Microsoft, I'm dealing with AIG, American Insurance Group, or I'm dealing with ExxonMobil, or I'm dealing with such big company and such big company. But even if I'm going to be an investor, I would have personal doubt that boss, who guarantees that? For that, companies go something which is known as credit enhancement structures. Now, in this credit enhancement structures, actually it is of two types. One is the internal credit enhancement structures and one is the banks. The bank credit enhancement structure is, Microsoft issue $500 billion of pool and also the value of the covered bonds is $500 billion. I will go to, of course, assuming my banker is Goldman Sachs, I will go to HSBC and HSBC will put the stamp on my indenture. Indenture is actually a document. HSBC will put a stamp on my indenture that, excuse me boss, even if this pool turn out to be zero, even if the Microsoft rating, which is currently AA plus, will go to BBB minus, for the sake of example, I will pay. Because of this, what would happen? The rate of interest which Microsoft is paying will get down substantially, and of course HSBC will not do it free of cost. Then comes the hedging. This part is 99% being avoided in Europe, and in US people are now taking care of that. The issue still exists. If there is a default in or if the value of the pool will get down. The value of the pool will get down because of two reasons. Number one is the market risk. Number two is the credit risk. If it is get down by market risk, then HSBC will play its key role. But if it will get down due to credit risk, example, out of this 500 billion, you have a big client of, say you have 5 big clients who own 45 or 50% part of that. And they defaulted. Now what is a default? It's a credit default. Since they defaulted, there is an issue in the pool. This will not covered by HSBC. To protect this, Microsoft would be taking the credit positions. Of course, it's up to the treasury person of the Microsoft how he's going to be taking it. He could take single name CDS, multi-name CDS, single trigger, multi-trigger, first to default. My favorite is always first to default, second to default, nth till default and all. And once they will take the credit position, they will give to the investor. Now, sometimes some people will refer this as a dual course investment strategy. I hope you are able to read it here. Dual course investment strategy. The reason being, you have a comfort that I'm dealing with Microsoft with the credit rating AA plus. Even if the credit rating will went down to BBB minus, I have this pool who is here to secure me. Even if this pool value down to 0, I have HSBC to secure me as far as the market risk are concerned. Assuming the value of the pool get down because of the credit risk, I would have the CDS here who is going to be protecting me. Of course, Microsoft was taking a CDS position. Of course, they are going to keep both Goldman Sachs and HSBC into consideration. They need to decide what would be reference obligation and what would be the notional obligation. That is something which is very key. There are various types of covered bonds. One is the legislative covered bonds, one is the structured covered bonds, and one is the credit enhancement covered bonds. Now, in the legislative covered bonds, like the perfect example is Germany. Germany have a dedicated legislative as far as the covered bonds are concerned. Not every bank, not every financial institution, not every corporate is approved to issue a covered bonds. So they have a legislation. If you are falling under the legislation, you are most welcome. If you are not falling under the legislation, you are gone. Then they have a structured covered bonds. There are a lot of companies, of course everybody is not Germany, so there are a lot of companies who do not have a separate legislation. Like in US also, we do not have a separate legislation as far as the covered bonds are concerned. They have a structured covered bonds. So here a relevant structure has been prescribed by a central bank or a regulatory body. If you are having that structure in place, then you can issue that. So here is a legislation, here is that structure. Third is credit enhancement structure. There are countries, without quoting the name, who do not have either of that. Now what people would do if they want to have covered bonds? In this, they need to maintain the over collateralization of at least 10 to 20%. And of course that too after haircut. Now what is over collateralization? Now Microsoft wanted to have the covered bonds of $500 billion. If there is a 10% over collateralization, then the value of the collateral, which is this pool, has to be $550 billion. If it is 20% over collateralization, it has to be $600 billion. And every minute, every second, Microsoft has to maintain that over collateralization. Either it's a 10% or a 20%. If they're not been able to maintain so, they need to tell to the regulators why they're not been able to maintain so. As simple as that. This is how actually the covered bonds move. The wonderful market for the covered bonds is Singapore. You have US is also a wonderful market growing. Europe, not to mention, it's a parent market for covered bonds. And again, while winding up this video, Treasury Consulting LLP fixed income platform is having a dedicated credit risk, structured risk, and bond risk. There's covered bonds and everything is been covered. This is just the start, not the end. Lot of things to come. In case you have any question, you're welcome to give. My mobile is 9899242978, while Skype ID is Rahul5327. My email is rahul.magan@treasuryconsulting.in. Our website is www.treasuryconsulting.in. Okay, so the beautiful website which is on the way. On first, www.fixedincome.global. Our KPO, which is 911140199774. Thank you and have a wonderful time ahead. This is Treasury Consulting.